Well, thank you for joining me in this week's update. We're going to get right into it. First and foremost, if you have questions, we have our quarterly chart party coming up very, very shortly. The great time for big questions for us to give real long and articulated answers. Email us here or text us there. This week, why don't we have more international exposure in our portfolios? Well, we get compared a lot to a lot of different indices. We get compared to a lot of different things. We get compared to a lot of different investment strategies. But the thing I probably get compared the most to is whatever is most up most recently. And right now, that is without question international investing. So we're going to be taking an in-depth dive in this chart. What does that really look like? Well, this chart is through end of last week. Let's take a closer look at the table. The U.S. Through the end of September was up about 14%. But ex-U.S., the rest of the world's up 25. Right? The EFA, Europe, Australasia, and the Far East is up 24. Eurozone's up 20 or 30, 33. Emerging markets up over 26. It's incredible performance. And so we get asked about that. But very quickly, and this is important, let's not even look at those selected countries at the bottom. Let's just look on the right-hand side of this chart. 2024, the U.S. is up 25. Nobody else was even up double digits. Right. And if you think about that, that's adjusting for U.S. dollars, which we always should when we're comparing investments, because you don't just usually get to capture everything in the local currency unless you want to hedge it out. So you have to do it in U.S. dollars. It wasn't that great. As a matter of fact, anything you bought January of 24 and you've held it now for the last little over a year and a half, I guess year and three quarters, you're net ahead in the U.S. versus all those other major world indices. And in that far right column, 15-year annualized returns, 15%. Ex-US, 7. Emerging markets, 4.6. Eurozone, 8.3. In 2010, the US and the Eurozone were almost the same size in terms of overall economic production. Today, the US is 50% larger. The US has continued to grow at a much faster rate, even at 2.1% growth from an economy standpoint, than all of Europe has. Emerging markets, they're up 4.6 in terms of their stock returns. You're taking a lot of risk in emerging markets, far more than you are typically in the United States. It's a much more volatile series of companies. And if you're going to take a lot more volatility, I expect higher returns. And on a 15-year basis, remember, whenever we're doing investing, we're not looking at what we're going to make for the next 5, 10 months. I'm looking at what we think is going to happen for the next 5, 10, 15 years. Take a lot of volatility, a lot of risk for this not to work out very well. And if you look back historically, pick on emerging markets here, outside of 2018, where they had, I think, a 10% outsized performance over U.S. large cap, you're hard pressed to find a period where they outperformed much at all, and for most of the years were vast underperformers. It seems like every 7 years is a big deal in EM, and you make a lot of money, and then you explain the underperformance for the next 6 years for it to average out to 4.6%. That's not, in our opinion, a winning strategy. You would have been better off in a lot safer investments, earning 4.6% over that same 15-year period, and that includes, this latest growth spurt. Brazil is the all-time winner right now. It's up 39% in terms of its U.S. Adjusted returns, but on a 15-year basis, steadily shrunk by 0.2% each year. That's the annualized return rate. So yeah, it's winning this year, but it has not been winning a lot over time. And our goal is, again, over time. It's what do we think happens for the next 5, 10, 15. That's what investing should be. It should be looking out forward. Most of what you pay for when you buy a company is its earnings beyond 2 years. So why am I that worried about the next 2 months? The answer is we're really not. One of the key criticisms I get of our view is what we call mean reversion. And mean reversion can be a very helpful tool, but it's not the end-all be-all. And mean reversion is really simply the idea that if things are high, eventually they'll go back to a median or a predetermined level. If things are low, well, they'll come back to a median or predetermined level, and you should invest based on that. But that assumes that these things are highly interconnected and that they're equivalent. And let's look back here. Since 1987, this is the last 38 years, in terms of market cap, what size are their stock markets? Japan was almost 40%. Now, we all know Japan's gone through a 30-plus year period of pullback. We're not even close. We're at 5%. What makes that return? The answer is we were probably overdone at that point. Remember, at one point, I think it was 1990, people thought all of Japanese real estate was worth more than all of the United States' real estate. That's a tiny country. We got a lot more farmland, a lot more productive area than they do, and that was the thesis at the time. Well, that unwound. That came back down to 5%. Europe, ex the UK, yeah, it had a period where it went up and it went back down to 11%. It's part of that. Emerging market debt was zero basically in 1987, and today it's close to 10. That's immense growth, by the way. I mean, 0 to 10 is a huge number, right? As a multiple. But yeah, is that great growth? But is it going to go back to zero? Does it have to revert to the mean? No, I don't think it has to revert to the mean of zero for a long time. I mean, this is a period over which 1987 we had like 40% global poverty, people making less than $2 a day in 1993 dollars. Today we're under 8. We're closing on like 4%, depending on exactly how you measure it. It's like global poverty has been decimated over that period, and EM is exploded as a result. But does it need to, you know, is it going to go back to zero? Is it going to revert to the mean? Our answer is probably not. And then the last thing is the same for the United States. It was 30% of global stock market. You know, in 1987. Today, 65%. It's continued to grow, and if it's continued to grow, does it have to slow down because of somebody else needs to catch up? There's no requirement that that has to happen. We don't have to revert to the mean. And the only way we revert to the mean is if all of those things are equivalent. And there are different ways in which these economies interact and work. We take it for granted, but the fact that if I drive to Minneapolis or Detroit or Chicago right now, that they're going to speak my language, we're going to have relatively similar customs, and they're going to take my currency is not a given in all of Asia. It is not a given in all of Europe. It is not a given in all of Africa. Those are not given things. So you do have to look at those things as different. Our economy does have an ability to grow, and it's been proven that it's an ability to grow over time. And when we're looking, yes, is this year would it have been better to refocus and do some of those pieces? Maybe, but you are taking a lot of overall risk. And remember, when you're investing, do I believe in this not for the next few months, but do I believe in it for the next 5 years? And I think our answer is no. We're still probably going to be more U.S. centric than is otherwise typically advised by most large investment firms. And if that's the case, we're okay with that. That's where we think we're going to be. We're going to do better. We think the U.S. We had a really strong currency, and we expected it to somewhat devalue. It was near a large high. As it devalued, it was going to inflate the numbers of returns elsewhere ex-US. As a matter of fact, if you look at that first table, uh, yes, the Eurozone's up 17.8. We're up 14. It's only when you adjust for currency that they're up 33. It's the currency adjustment is where you made most of that, not actually in their overall global growth. It's in currency adjustment. And again, on a 15-year basis, net behind. So with that, I'm going to conclude this week's book, Americana, 400-Year History of American Capitalism. I didn't know this was going to be a question in this 2-month period, but this probably wouldn't be a bad read if you really want to understand why we think American capitalism is a little bit different and why that's important. So check the review here, and hopefully we'll catch everybody at the chart party in a few weeks, and we'll talk to everybody very soon. Thanks again for joining us.